So it is tax season. Well, hopefully you know that. Otherwise, you probably need to get going on your taxes. And we got a couple of tax-related topics, appropriately enough, given that it is tax season. First, we're going to talk about something that less than 5% of Americans have actually done, and we're going to really recommend that you do that here on the program today. And what we're talking about is the option that you have to receive a PIN number, a tax filing PIN number from the IRS that is a unique number that is designed to prevent tax identity theft, which unfortunately is a growing issue in today's world, particularly as AI and the dark web and all that kind of stuff. Your Social Security date of birth is probably out there somewhere. So all it takes is somebody to grab that, file a fake return, and voila, get some made-up credit into their account. And then when you file your return, guess what? It gets rejected, and you have to prove that you're you. Talk about kind of a bit of a pain, right? So anyway, we're going to talk through how to do that. I actually did it this past week. I hadn't done it before, and I said, well, if we're going to make the recommendation to people on the radio program that this is something that they need to do, well, perhaps I should do it first in order to be able to explain it and to tell it. So we're going to talk about that. That one is pretty important. And then we're going to talk about some specific taxes that apply as it relates to investments, right? This is, of course, a financial-oriented show. We talk about investments a lot, so probably good to talk about the particular taxes that might apply on investments. The key piece in all of those, in that tax conversation as it relates to your investments, is timing. Depending upon your timing as it relates to your investments and utilizing your investments and having to report different transactions involving your investments on your tax return, timing is going to be very crucial as to whether you're eligible to get a lower tax rate or, in fact, you have to pay a higher tax rate. So we're going to talk about that on the program. So welcome on in to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, also coming to you on a host of podcast platforms as well, along with our YouTube channel. If you check out our YouTube channel this week, you'll notice, of course, that we are appropriately wearing a green tie. The original air date of this program is technically, I guess, the day before St. Patrick's Day, but I'm pretty sure that there was a lot of St. Patrick's Day parties over the weekend. So we hope you enjoyed whatever those festivities were. And of course, my name is Joel Garris, a certified financial planner and a certified financial fiduciary at Nelson Financial Planning, where we got a team of folks who also happen to be certified financial fiduciaries as well. They stand ready to help you improve your life with a successful and cost-effective financial plan. So make sure you reach out to them this week. Visit our website, nelsonfinancialplanning.com. You can always schedule an absolutely free appointment at any time to talk through your overall financial picture with one of our great people who also are certified financial fiduciaries. So it's a full show, and I guess we could use a little bit of the luck of the Irish to turn the headlines around after another full week of some tougher headlines and, of course, some economic data as well. Week certainly got off to a rough start on Monday with the declines on Monday, particularly on the tech-heavy side of things. So if we look at the NASDAQ index, I think on Monday it had its worst day in over a couple of years or so, since like September of 2022. That did not just end on Monday. The rest of the week continued to have quite a bit of volatility for the overall markets. And as we said before, clearly a return of market volatility like we talked about last week on the program, what happens when volatility returns, it has a tendency to kind of stick around for a little bit. So don't magically think that all of this is going to disappear or dissipate over the course of the next few days. More often than not, it kind of sticks around. But of course, we'll have some advice as to what you need to be doing now. In terms of the economic numbers, inflation data came out on Wednesday, actually pointed in a good direction, dropping from 3% in January down to 2.8% in February. Again, that's February. That doesn't include March, where we've had a lot more headlines and conversations about tariffs and things like that. The core inflation number that came out this past week for February excludes the core inflation is the one that excludes food and energy. That came in at 3.1%, which was the lowest year-over-year reading since 2021. So sort of decent economic news on the inflation side, but certainly not enough to offset some of the consumer angst that I think is getting generated as a result of the headlines coming out of Washington these days. And of course, all of this simply heightens our concern about perception becoming reality. We've talked about that a little bit over the past couple of weeks. And certainly as we described in the communication we sent to our clients, not this past week, but the week prior, talking about the level of uncertainty and the headlines out of Washington eventually causing or potentially causing people to sort of change their behavior, right? So if you change your behavior, then ultimately you wind up having a much more direct economic impact. And that's just sort of what uncertainty creates. I saw an interesting little factoid that puts that level of uncertainty into perspective. And it was the most recent release on March the 5th of what is known as the Federal Reserve Beige Book. Now, this book, if you will, is a report that actually contains a variety of anecdotal insights into the U.S. economic conditions. The terms uncertain, uncertainty, and uncertainties were mentioned a record 47 times, surpassing prior peaks from COVID, the financial crisis of 2008, and the dot-com bust going back all the way 20 plus years ago. So uncertainty clearly reigning supreme, and obviously that can eventually cause people to change their behavior. Maybe that's not eating out, or maybe not taking a vacation. The consumer view or expectation of a weaker future can often be sometimes be self-fulfilling if there is that high level of uncertainty. And certainly if that perception translates to reality and consumer action, then you could certainly see some impact on from a real economic perspective. Bottom line, as we said on the program last week, great time to double check your overall investment allocation. That's the number one thing that we would encourage people to do right now. We talked about sort of last week on the program, we talked about sort of verifying how much of your portfolio you have on the conservative side of things like cash and bonds, but specifics certainly matter when you're doing sort of that analysis. And when we think about bonds, you want to kind of dig a little bit deeper and find out things like, okay, well, what's the credit quality of these bond issuers? Is it AAA or is it C? By the way, you want AAA. Or what's the maturity on the bonds that I own? Generally, you're a shorter maturity, less subject to kind of interest rate fluctuations. Obviously, if it's AAA rated, that's a higher quality issuer as well. Obviously, you know, bonds over time don't make as much as stocks. And that's, you know, kind of what that means, because bonds over time have less volatility. So they certainly do serve a role as the conservative side of your portfolio. One caveat there is don't go, you know, too heavy on that. You don't really need to be all that heavy on it. You just want to make sure it's there as a part to potentially provide income and cover, you know, a 3, 4, 5 year period of time. Now on the stock side, make sure that you're digging deeper there as well. Particularly on the international side, what's interesting is so far this year, the international markets are actually having one of their stronger years in quite some time. So certainly important to kind of look at that overall perspective and dig deeper and see what it is that you have, what types of bonds that you have, what types of stocks that you have when you're checking your allocation. Bottom line, double check. Don't make any big wholesale moves, because it's never a good time to do that so long as your overall investment allocation is where it needs to be. Talking a little bit about volatility in the markets in that last segment, and what you can do now about that. Bottom line, make sure you're digging a little bit deeper on your overall investment allocation. Good time to really double check that. Obviously, you don't want to make any dramatic moves, assuming that your overall investment allocation is where it needs to be. If you're not really sure if your overall investment allocation is where it needs to be, well, then maybe it's time to go to our website and set up an appointment with us so that you can get a better perspective on that. Our website, nelsonfinancialplanning.com. So speaking of volatility in the markets, we talk about volatility in the overall stock markets, but when volatility strikes, it actually shows up sort of across the board. And that also expands to sort of even sort of riskier asset classes as well. Seeing that in crypto. If you look at Bitcoin over the past 30 days, it's down like 15%. And then what was also interesting is there was an article that was in the February 2025 issue of the Quarterly Journal of Economics that talked a lot about crypto, did sort of an analysis on it and whether it would, in fact, be a part of sort of the global financial system at some future date. So you have that article. And then that article actually is juxtaposition, or I guess sort of almost goes hand in hand with the other headline involving crypto over the past month. And that is one of the largest crypto hacks actually occurred, courtesy of our good friends in North Korea. You know those guys? So you have this massive hack and theft of 1.5 billion in cryptocurrency, and you juxtaposition this versus this academic study, this research about crypto and the platform itself. So let's get to the first part of that story. So apparently North Korea was able to hack into the crypto exchange called Bybit and steal close to $1.5 billion of cryptocurrency. Many are saying that was one of the factors that has contributed to the recent decline in the value of Bitcoin, but it also highlights one of the major problems involving cryptocurrency in general, right? The digital nature, the lack of transparency, all of those kinds of things make crypto more susceptible to hacking. And given the success of this North Korean theft, it's widely expected that that will, in fact, encourage other state-sanctioned criminal enterprises, so like Iran and Russia and whatnot, to try their hand as well. Enter the other part of the story, which is the article in the February 2025 issue of the Quarterly Journal of Economics entitled Trust at Scale, the Economic Limits of Cryptocurrencies and Blockchain, courtesy of a University of Chicago professor named Eric Budish. His study that was published just last month concludes that crypto's vulnerability to theft. So here we are, have this study that is highlighting crypto's vulnerability to theft. And then you actually have one of the largest thefts that occurred, 1.5 billion, sort of just kind of reaffirms the study's conclusion that ultimately that vulnerability it keeps Bitcoin from becoming or being used in widespread use in the financial system. Now, the research in the article in the Journal of Economics really focused on sort of what it would take to protect crypto, not just from hacks, but sort of even more devastating threats that are more likely to be engineered courtesy of artificial intelligence. The study concludes that the cost of protecting cryptocurrencies to the point where they would become a part of the global financial system is so high as to exceed the entire global GDP. You see, another way to put all of that fancy economic professor scholarly work to summarize it is trust ain't cheap. Okay. And if someone can just steal your crypto with the right technology, then you're never going to really trust that. And so trust ain't cheap. And it's interesting, the conclusion in this article in the Journal of Economics that says, well, in order to create the parameters that would build that trust or have that trust, yeah, it's going to be so much more costly than even the entire global GDP. Because, see, the very nature of cryptocurrency is that it's completely anonymous, right? It's decentralized. It's permissionless asset without any support or regulation from any kind of government or intermediary or third party of any kind. And that ultimately is the single biggest sort of issue that ultimately winds up preventing it from having a major part in the global economic system. Think about it this way. If you trade a stock on an exchange, right, there's a host of intermediaries that are standing to the side of that transaction or sort of as an umbrella over that transaction that ensures that it is being done properly and someone's not stealing your money, right? There's the trading platform, there's the brokerage firm, there's the government regulators, and again, not to say you can't have your money stolen, but at the end of the day, there is intermediaries and government resources that are available that you can turn to when that happens. All of which are there to protect the nature of the transaction, all of which are to ensure that level of trust that is needed for something to actually be a usual and regular systematic use of exchange in the global financial system. Crypto, of course, by its very nature, ignores all of that. And the study in the Journal of Economics concludes that it does so at its peril. If the cost of protection is so high for crypto as to become more significant, as to be greater than the global GDP, there's no real way or path where it becomes part of the global financial system. Again, the summary is trust ain't cheap. And when it comes to crypto, there isn't. And when you don't know who's on the other side of the transaction, then there's no way to really trust what is going on. So bottom line, in today's world, obviously with the recent volatility, be careful with any asset class that also is a riskier asset class, because you will find that when volatility comes into the stock market, it comes into the riskier asset classes that are out there even much more so. So just be aware of that, because crypto obviously comes with those sort of traditional risks, but also has a lot of non-traditional risks as well. So that can often create a lot more declines than perhaps what you're bargaining for. So might be time to kind of get some perspective on this before somebody realizes that the emperor, in fact, has no clothes. What's that a reference to? Well, that's a children's book written by Hans Christian Andersen all the way back in 1837, now almost 200 years ago. If you've never read it, if you've never heard of it, you've never read it, it's worth a gander. Some timeless advice in there about how people can be convinced of things that clearly aren't true. Check it out. Hans Christian Andersen. You didn't realize you can get a book recommendation on the program this morning, but there you go. Anyway, we're going to wrap it up and take a break. We'll be back here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So let me tell you something. This is going to be the most important segment on this program. And this is going to be a something that is going to give 95% of our listening audience out there a key takeaway, a key to do, if you will, that is going to be more and more important going forward. So it's obviously mid-March. We're going to talk a little bit about taxes here in the rest of the program. And specifically, we're going to talk about some of the specific taxes that can apply on your investments and to make sure that you are paying the right amount on them and observing the proper timing, or at least getting details on the proper timing of those investment transactions, because that's going to determine whether you pay less taxes or you have to pay more. So we're going to hit that. But before we get to that, I really want to talk about how to protect yourself from tax identity theft, which is a growing issue thanks to the continued improvement in artificial intelligence and the expansion of the dark web and all of those kinds of things. What's shocking about this ability to prevent tax identity theft is that only less than 5% of Americans, so 95 have not completed the process with the IRS to be able to make it happen, to give that level of protection to themselves. Otherwise, they might very well fall part of the increasing number of people who have tax identity theft. So if you've never heard of it, if you've never run into it, I assure you it happens every tax season. We run into several tax returns that wind up getting bounced when we file them. And so here's kind of what has happened in the background. So for tax identity theft to occur, what happens is a criminal, fraudster, whatever you want to call them, uses a real person's information, right, such as their date of birth, social security number, probably pulled it off of the dark web, and they use that and they file a totally fake tax return in that person's name. Now, the fake return will then include a completely made up refund that typically goes into the fraudster's bank account. Then, when the real taxpayer files their actual return with the IRS, guess what happens? The computers reject it because we already processed this other return with your name and social security number and all of that. And here's the kicker. Here's the thing that will just, kind of burn you on this thing. So you're the victim, okay, the real filer, right? You're the victim of this. But it's on you to resolve the problem when it happens by providing affidavits proving that you're you, providing affidavits, submitting, identifying information, having to file paper returns, not able to file electronically anymore, not even able to have direct deposit on your refund, so you're having to wait for that, for check coming in the mail. Unbelievable, right? I mean, couple that with the resolution process. So when one of these kind of tax identity theft fraudulent returns comes through, there's resolution system. Well, the process for that is getting longer because the number is increasing. At the end of 2024, the IRS had about 500,000 cases involving tax ID theft victims, and so that's 500,000. That's a lot. Okay, and over the course of the past 4 years, the average time to finish or fully resolve those cases rose from 4 months to 22 months, so nearly 2 years. So that's like 2 tax seasons in order to get this resolved. And in case you haven't realized, your the world certainly isn't getting safer. Chances are your data isn't getting safer from personal attack anyway. So how do you attack this type of fraud? How do you fight this? The IRS has a specific plan of action, and we wanted to go over that with you today. They encourage taxpayers to apply for a 6-digit IP PIN, which stands for your Identity Protection Personal Identification Number. For taxpayers who have them, the IRS computer rejects returns without that proper IP PIN on the tax return. But yet, less than 5% of Americans have applied for one. And folks, it's a pretty simple fix to prevent you from becoming a victim and having that burden of proof on you to actually prove that you are you. Once you get one, it's automatic. Every year you kind of get a new one each year in your online IRS account. So how do you get one, right? So, I mean, yes, there is obviously a process. It's not like you just pick up the phone or hit a button and poof, you've got one. There is definitely a process on this that is a little bit time consuming. So let's walk through that. So first, you got to prove that you're you. So you got to prove your identity, and the IRS uses a third-party website called ID.me. So you go to that website, and you submit your name, address, photo of driver's license, things like that. Basically the same kind of stuff I just submitted for the beneficial ownership information report that I did for Nelson Financial Planning. That's a topic, obviously, if you follow the program on a regular basis, we've been updating you again. All of that BOI reporting is under sort of still in suspension now. So you don't need to worry about that, but it's that kind of stuff that you have to provide. So once you submit all of that information to ID.me, then you're going to be able to ask the IRS to give you a IP PIN number through your online account with them, and then it gets auto-generated there. So let me just kind of break that down a little bit. So you have to set up online accounts with both the IRS and ID.me, and you're going to need both of them because they're sort of talking to each other, right? ID.me proves who you are. The IRS login is how you actually obtain your PIN number. So, and that's kind of the toughest part of it. Setting up the accounts, once you get through that, then it's pretty simple because it sort of automatically generates. So in preparing for today's show, I said to myself, well, if I'm going to recommend this as a plan of action for people, well, maybe I should do it myself. And so I decided to go online and get one. The process itself was relatively simple. But again, I already had an online account with ID.me and IRS.gov. So I was able to kind of go through it. So that didn't have that kind of hassle. But I remember when we did set that stuff up, yeah, it takes a little bit of time to do that. And then, of course, you know, I had to verify I had the right username, password, and all that kind of stuff. But I did, so that's good. So it actually wound up being relatively quick. So that's the process, folks. And certainly something that you want to put on your to-do list. Unless you like the notion of having to someday prove that you're you to the IRS and then have to wait 2 years before it gets resolved. You probably don't want to do that. The reality is chances are your Social Security date of birth is already probably floating around out there on the dark web. So make sure that you do this. Get your IP PIN courtesy of the IRS. Because then that does shut down any chance of becoming a victim of tax ID, identity theft on your tax return. We're going to take a break and continue here on Dollars and Cents after these messages. Here, this is Joel Garris of Nelson Financial Planning. Folks, I can't emphasize what we were talking about in that last segment enough. Put that on your to-do list, okay? Yes, it's going to take time. You're going to have to create an account with ID.me. You're going to have to prove who you are. Then you're also going to have to create an online account with the IRS through irs.gov. But folks, the incidence of identity theft that plays out on tax returns is growing. and it's growing every single day. And with the advent of technology being what it is, you know that that's going to happen more often. And what's crazy is that less than 5% of Americans have asked the IRS to issue out their own IP PIN number. And the process, yes, there is a process, but that really does help to prevent you from becoming a victim of identity theft on your tax return. Because if you are, they're taking a long time, up to 22 months on average, to resolve those cases. So that's a long time to have that pending and outstanding out there. So make sure you check that out. IP PIN, okay, is what it is. It's a 6-digit number. It will be assigned to you courtesy of the IRS once you prove who you are through ID.me. Put that on your to-do list, and that'll keep you safe or safer from identity theft as it relates to your tax return. So shifting gears, we'll talk a little bit about some specific tax rates on investments and what you need to know to minimize your taxes, right? So that's good. We're going to go through 4 of sort of the more common types of taxes on investments and what you can do to help minimize them. Bottom line on all of these, folks, there are major timing considerations on every one of these that you need to be aware of to make sure that you are observing sort of the proper timing parameters in order to minimize your taxes as best as possible. So first thing we want to talk about is the tax on capital gains. Now, a capital gain is a profit from the sale of an asset, whether it's a stock or a mutual fund or a piece of land or business or whatever the case may be. And basically, a capital gain is the money that is that you make that was in excess of what you invested or put into that asset in the first place. That difference is the capital gain. Now, here's the key piece. The rate you pay the rate of tax that you pay on that capital gain depends directly on how long you held the asset before you sold it. If you held it for at least a year, that is considered to be a long-term capital gain. And in that case, you have available to use a much lower tax rate, particularly in comparison to ordinary income tax rates. So the key piece there is you got to make sure that you held it for a year. We say much lower tax rate. Yeah, income tax rate at 12%. Your capital gain rate is 0. Doesn't get much lower than that. And so those capital gains rates for long-term capital gains are 0 or 15% or 20% versus the income tax rates, which go all the way up to 37%. So timing on this one really matters. To the extent that you can kind of wait on the sale of an asset to have it be more than that year, to trip that threshold. This one really matters in terms of how much tax you're going to pay. So don't sell something on day 364 after first buying it. Sell it on like day 366 or 367. So then you get the eligibility for that long-term capital gain treatment. So that's number one. Number two is dividends. Dividends are taxed, obviously, in the year you receive them, whether you received it as cash or reinvested it. Similar to capital gains, there are different types of dividends and different types of tax rates that apply to those dividends. So a dividend can be either qualified or non-qualified. And just like capital gains, that is based on timing. So if you own a stock or a mutual fund for more than 60 days, within the 121-day period, starting 60 days before the ex-dividend date, the date that the dividend paid out, then it makes it qualified. So that's kind of a convoluted explanation, but that's the technical explanation. So basically, you got to own for like a 60-day period at or around the period of time where that dividend was paid. Now, a qualified dividend, so assuming you meet that holding requirement, then gets a lower tax rate, the same lower tax rate that applies to those long-term capital gains. So that's as low as 0% again. Doesn't get any lower than that. Tax rates, of course, max out on these at the same 20% as they do for long-term capital gains. But contrast that versus ordinary income rates, which go all the way up to 37%. Now, if you miss the timing or the timing doesn't apply, then your dividend is non-qualified. This taxed at those ordinary income tax rates and subject to those higher regular income tax rates. A key piece here is that you really want to make sure that you're reporting your dividends, if they are qualified, as qualified dividends. We regularly see folks that have prepared their own taxes, or maybe they've used a online software, or whatever the case may be, and they forget to draw that distinction or make that differential between. Excuse me. Did we mention high pollen? Okay, in the weather report. So the distinction between qualified versus ordinary dividends, we often see people sort of fail to make that distinction. And when they do, that just means that they're paying more taxes than they really need to. So make sure you're not overpaying your taxes. Make sure you also respect that timing window of that 60 days in order to make that dividend, in fact, a qualified dividend. Number 3 is, of course, taxes on withdrawals from your retirement account, right? If you're contributing on a pre-tax basis, then you save money on your taxes when you contribute that money, and then you pay when you withdraw. If you're doing it on the Roth, it's after-tax money, and you don't have to pay taxes when you take the money out. Timing here matters too, right? Because specifically, how old you are determines whether you are going to be subject to a penalty or not. Beyond the income taxes you're going to have to pay, particularly if it's a pre-tax retirement account. If you're under age 59 and a half, there is an extra tax penalty of 10% on those withdrawals. So know your age on that one, right? If you're close to 59 and a half, you probably want to get to 59 and a half in order to avoid the extra 10% tax penalty that will apply. Now, yes, there are a variety of exceptions to that penalty that you can claim, but be aware that the burden of proof is on you that to prove that you are, in fact, eligible for one of those exceptions and to become exempted from that early withdrawal penalty of 10%. So there, withdrawals on retirement accounts, age matters. Make sure you're over 59 and a half. And then lastly is a situation involving selling your home, right? So what's interesting here is that if you sell your primary residence, you can actually, as a single person, exclude up to $250,000 of gain. As a married couple, you can exclude up to $500,000 of gain. But to qualify for it, you got to meet very specific timing requirements. And those timing requirements relate to how long you lived in the house as your primary residence. It has to be 24 months of the 60-month look-back period from the date you sold the house. So look at the date you sold the house, go back 5 years effectively. Hopefully during that 5-year period, you were living in that house as your primary residence for at least 24 of those 60 months. If you are, then you qualify for this exclusion, which obviously is a pretty valuable exclusion because that means you don't have to worry about any taxes on the profit that you made when you sold your primary residence. Now, if it's over $500,000, okay, fine, you've got to pay some taxes on that additional capital gain. So timing really matters when it comes to minimizing your tax bill, particularly when it relates to your investments. So make sure you know the rules and how to minimize that. Because obviously the goal is to try and minimize your taxes as best as possible. Well, with that, we're going to wrap up this week's edition of Dollars and Cents. We want to thank you all for listening to this week's program. If you have any questions about anything that we talked about, or have something that you either want a second opinion on or just need some financial help in general, don't hesitate to go to our website at Nelson Financial Planning and set up an absolutely free conversation. This is Joel Garris of Nelson Financial Planning. You've been listening to Dollars and Cents.